Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Asian equities outside China climb as traders sidestep the hotter-than-expected core inflation print out of the U.S. 3 Fed officials seemingly unfazed by the CPI report. Mainland Chinese stocks extending declines ahead of Saturday's crucial briefing by the finance minister. Investors expecting around $280 billion of new stimulus. Plus, Israel's security cabinet meets to discuss how to retaliate against Iran for last week's missile attack. It has just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. As ever, we have a really jam-packed show to get through. We're not just going to be talking about U.S. markets, the reaction to that CPI print, but also all of the activity in Chinese markets, geopolitical developments, the Tesla robotaxi launch, in addition to various other developments in Europe as well, including the French budget. So let's just get straight to it. As you can see yesterday, the close for S&P was a little negative, down about 0.2%. There we had hotter than expected CPI numbers come through, a bit of a surprise to the market, but at the same time, we did have an uptick in jobless claims. So the market was torn between whether putting too much emphasis on the inflation data or on the labor market data. In the end, what we saw was a slight soft ending for the S&P, pulling back from those record highs. 2-year yields also didn't really know what to do, but in the end, rallied a little bit. We were a couple of basis points lower by the end of the day. Today, not a lot of movement, but sitting at 3.96. So the curve is actually in positive territory. The 10-year is trading at a higher yield level than the 2. People have been watching that closely. Brent sitting at $79. We are just down about 0.3%, but still up around 2% over the course of the last couple of days. Again, we talk about geopolitical premium and a lot of tension in this market as the world awaits for Israel's reprisal to those Iran ballistic missile attacks. And then Asia Pacific, the handover, broadly speaking, ex-China, has been pretty positive this morning. We'll talk more about that in a moment. We are up 0.3%. But I just want to show you one thing, not the CPI data. I actually just want to highlight to you those jobless claims figures that came through, because as you can see from here, a little bit of an uptick at the end of that chart. And that tells you that we have seen the biggest jump in 3 years on, of course, the back of the Hurricane Elaine effect, but then auto cuts playing its role as well. So some people were pointing out to that figure and saying it could be an anomaly, but it could also be a sign that there's further deterioration to come in the U.S. labor market. So that's that for U.S. markets. Let's check in now on how markets in Asia are faring this morning. Avril Hong is in our Singapore studio ready to give us more. Avril.
Yeah, Jumana, we're seeing Asia stocks in a pretty good mood heading into the weekend, shrugging off that hotter-than-expected U.S. CPI print. But to your point about China, that is where we're seeing that underperformance. CSI 300 declines of about 2%, erasing the gains of just a day ago. And that is despite investors, based on a Bloomberg survey, coming in with a bit of an estimation of how much stimulus we could actually be seeing announced on Saturday by the Chinese finance minister, $283 billion. And this is also coming despite the Chinese authorities announcing yet another briefing, this one on Monday, and potential support for firms. So you can see how investors are bracing for a disappointment out of the weekend. Now, apart from the big picture, a company that I wanted to highlight in terms of stock market moves is Nomura. It has erased gains after Bloomberg reported that it could temporarily be excluded from government debt auctions, and this is after it admitted to manipulation of the bond futures market. So this is what we're seeing in my part of the world, Joanna.
Yeah, excellent. Avril, thank you so much for giving us that important overview. And again, expectations seem to be building once more vis-a-vis these Chinese stimulus measures. Now, let's switch on and talk about the U.S. yesterday. 3 Fed officials say they are unfazed by higher than forecast U.S. inflation in September, suggesting the U.S. Central Bank can continue lowering interest rates. Let's bring in Maurice Gravier, Wealth Management Group CIO at Emirates NBD. It's always great to have you on. So I was just highlighting some of the data that came through yesterday. Obviously, CPI was a bit of a surprise. First of all, do you think the market is being too complacent about where inflation is headed? Is there a possibility that it stays sticky?
Yes, of course, there's definitely a possibility, and I think that what matters for market is more what will the Fed do with it than what is inflation by itself, because headline inflation around 2.5, it's fine for consumers. It's about core inflation and the Fed, and we believe that the Fed is going to cut whatever happens, because it's a matter of level. It's not a matter of dynamics. Yes, if inflation is sticky, you could say you shouldn't cut rates, but given the level and how restrictive the policy is, I think they will continue to cut.
Because real rates have continued to move higher. What did you make of the FOMC minutes the other day? I mean, people put out their magnifying glass and were analyzing whether it was some or several or whatever, but the point is that it seems as though a good chunk of the committee were not in favor of this 50 basis point rate cut.
Absolutely, and when we know the diplomatic language that is used by the minutes, I think there was a strong pushback, and at the end the majority were voted for this double cut because probably part of the group already wanted a 25 basis points cut in July, and I think that this part of the group that took the majority. I don't know, for me the Fed is a bit nervous. What matters is that they have prioritized employment over inflation, because they think that the risk of seeing employment deteriorating is bigger than the risk of stickier inflation. That's why we believe that they will keep on cutting, but I'm very happy to see that expectations are much more reasonable. We expect 2 more 25 basis points cut this year. Expectations were crazy before the NFP job report last week, and now they are much better.
I thought it was interesting. Our colleagues at Bloomberg had conversations independently with Jamie Dimon and with Ray Dalio, and both of them seem to suggest that rates could be higher than what the market is anticipating. Yields will stay higher than what the market is factoring in. And perhaps that explains some of the upward movement that we've had in yields over the last week or so. Do you think that there is perhaps, again, the market is getting ahead of itself in terms of how far the Fed are going to cut in this easing cycle?
It's very possible, and it's very interesting because, of course, with this illustrious gentleman, I couldn't disagree, but we were a bit cautious on the long end of the yield curve, because we think that structural inflation is here to stay. You have debt sustainability questions that will arise in the coming years. So we overweight bonds, but with a very reasonable duration, because we want to lock yields to be exposed to what we believe is an easing cycle that has started and will not stop, but we don't want to take too much duration.
Where do you lock in bonds? Here, around 4%?
Yes, we like the belly of the curve, I would say, around the 5-year of duration. And of course, 4% is a very good yield.
What are you thinking about equities? We are starting earnings season today, starting with the banks, always good to watch. But in general, valuations have moved richer over the course of this year. We're again at record highs, or close to, very far, very, very close to those all-time record highs. Do we keep going?
Absolutely. So first, the backdrop is supportive, because if anything, between the easing cycle globally in the West and the Chinese stimulus, I mean, growth is here. This inflation is pretty much there. The issue is valuation, as you said, and the US stocks in particular at 21 times. When the 10-year is at 4%, I mean, you have an earnings yield that is below 5, and the 10-year at 4, it's too stretched, and then it's about the risk of volatility spiking. I mean, we have no shortage of potential catalyst for volatility, so we are underweight in equities. The only exception is that we just turned overweight on China, which is a bit probably controversial. But
interesting. So did you put that on before it rallied 20% or after our Chinese stocks fell this week? I'm just curious about the timing. What was the trigger for you?
I will be very transparent. We were neutral on China, which was a much bigger positioning than most of international investors, because we said, okay, there are issues, but the valuation is really low, and the PE jumped from 9 to 12, something like that. And then we added this Wednesday when we saw this turmoil. We are overweight on China within an underweight in emerging markets. So it's not huge, but we believe that there is upside to come with volatility.
I was going to say, is this a trading opportunity or a longer-term investment thesis that you think is going to play out?
Well, to some extent, the market action will tell you, depending on the rest of the opportunity set. But we believe that it's something that will unfold. It's not about trading this Saturday or next Monday's briefing. It's about the fact that we take the Chinese authorities very seriously when they want to support growth.
So let's say we walk in Monday morning and there is disappointment once again that the stimulus package isn't big enough. Market pulls back. Would you buy into that?
We don't move that much. I mean, it's a matter of tactical asset allocation. We've built our position, and we are confident to see, I would say, 15 to 20% upside. And yes, the package is probably too small. Everybody speaks about 2 trillion yuan, which out of a 125 trillion yuan economy is not that big. But still, valuation, even after the re-rating, is not excessive, and we take the authorities seriously.
Yeah, it's interesting. We're getting a broad array of different views. Yesterday, we had someone on who's a lot more skeptical about whether China could achieve their goals. So it's good to have a whole different range of perspectives on where things are going. Maurice, thank you so much for joining us. Always good to talk to you on a Friday, nonetheless. Maurice Gravier, Wealth Management Group CIO at Emirates NBD. Well, Elon Musk has unveiled the long-awaited prototypes of a Tesla robotaxi called the Cybercab, saying that production may start in 2026 and that the vehicle could cost less than $30,000. Let's bring in Bloomberg's EV supply chain and aviation reporter, Danny Lee. Danny, so bring us some of the highlights from this Tesla launch. I know it was a little bit delayed, but then what did we get once Elon Musk started speaking?
Yeah, this autonomous robotaxi, it's officially called the Cybercab. It looks very, very striking indeed. And it's really hard to understate how important this launch, this delayed launch really, is in determining Tesla's future and the future direction of the company, frankly. But we'll get onto that in a moment. But more just about what we heard in detail, the fact that, as you said, this will be sold directly to consumers. It'll be sold for under $30,000 and it will be put into production in 2026. But here's the thing, this is still a prototype and we've had this event launch delayed from earlier in the summer. And for Elon Musk, he's had a long track record of not sticking to what he has said in terms of timing, on pricing, on product, on launches. So take what he says with a pinch of salt, frankly, and given how much he has to do to get this into real-world conditions, into something that is really drivable.
Danny, how much is an announcement like this likely to move the needle on Tesla stock? Well, and what has investor reaction actually been so far?
I think you can judge from the crowd, who are many, I'm sure, retail investors, really loving the performance that Elon Musk put on tonight. But for the institutional investors, clearly they'll be thinking hard. Lack of detail, though, must stress from tonight about what this product actually means for the future direction of Tesla, particularly around this autonomous robotaxi, this Cybercab, and what this means and how Tesla could utilize it to really drive its product lineup and in terms of potentially services it could offer. But, this is still important, the fact that when regulators look at something like this, will they be on board? This is a Cybercab, for example, which has no steering wheel or pedals, for example, so it's very striking. Must just point out that Tesla did unveil a robo-van as well, as something that could fit up to 20 people. So that was one of the extra highlights of the night. But we still need to hear more details on just how this product can work, particularly on with boots to AI and Tesla's AI capabilities here.
Yeah. Well, whatever they're doing, they're certainly putting on a show. We're just keeping track of live pictures coming out from the robo launch. And I believe it's a handful of robots dancing. That's besides the point. The point is that there is plenty of excitement about the unveiling of some of the new features. And who would have thought that a car with no driver and no pedals would be met with such a resounding excitement. Danny, thank you so much for bringing us the latest on the robotaxi unveiling. Well, plenty more coming up here on Horizon's Middle East and Africa, including Congo's plans to pivot away from China's dominance over its mining industry, and why Stellantis is replacing its finance chief as part of a broad management overhaul. Stay with us. This is Bloomberg. Welcome back to Horizon's Middle East and Africa. I'm Jumana Bersachi in Dubai. Israel's Security Cabinet has met to discuss how to retaliate against Iran for last week's missile attack. This comes as U.S. efforts to influence Israel's decision remain in question. Meanwhile, Israel is stepping up attacks in Lebanon. The Associated Press says an airstrike on central Beirut on Thursday night killed at least 22 people and wounded dozens. The Israeli military said it was looking into the reported strikes. Stuart Livingstone-Wallace is our executive editor for Middle East, North Africa and Russia and joins us now. So we were talking yesterday about this Security Cabinet meeting that was going to be held to discuss the reprisal to the Iran ballistic missile attacks. It seems like we're not going to get detail, obviously, before the fact about what they're thinking of. But how significant is it that this meeting was held in the first place?
Yeah, I think it's just standard procedure. And I don't think we should read anything more into it than that. And they came out of it saying that the final decision is going to be taken by the Prime Minister and the Defence Minister, which again is, pretty standard. So I wouldn't overinterpret it, but I think it's confirmation that, yes, they're still on track. Yes, they've had a lot of phone calls, particularly with the US administration, but they're still on track. But we'll wait and see over the next couple of days what that might look like.
It's interesting. I was reading a piece that our colleague Zainab Fatah put out yesterday about where Gulf Arab states are in all of this. And that also coincides with the visit the Iranian foreign minister has made throughout the region. He also met quite significantly, I thought, with the Crown Prince, MBS. What is the leaning of Arab states now, and how significant is it, not just from a political standpoint, but also for the world of business, given so much business is also conducted in that specific region too?
Yeah, I mean, it's a real threat. It has to be said, we have not seen any signs yet that it is impacting business. People are still arriving, money is still flowing in, business is still starting. So there's absolutely no evidence that anything is happening right now. But it has to be a concern when you have a hot war on your doorstep and your own infrastructure is somewhat vulnerable, that could escalate. So it's absolutely clear that the Gulf Arab states at least are absolutely adamant that a path has to be found forward, because ultimately the region will thrive through economic growth and job creation and so on and so forth, rather than through continuing conflict. And we've seen some public statements about that. They are absolutely determined to keep to that path, because that is the future.
Also, there are vivid memories of the Aramco facilities attack back in 2019. Houthis were reported to be behind it at the time. We are in a different environment today when it comes to Saudi and Iranian relationships, but you've got to think that that's still at the back of their heads, that if there is a reprisal, it could also potentially entail a GCC oil infrastructure as well.
Yeah, and I don't think, I mean, just to be clear, I don't think there's any sense that the GCC would want to get involved or be part of this. However, that is quite an easy way, in inverted commas, for Iran to retaliate. Yes, it can hit or try and hit Israel, but we've seen how successful that's been over the last couple of attempts. But conceivably, part of the threat could be, well, we're going to take out our neighbours, or at least their infrastructure. Now, again, there's absolutely no sign that that's happening today, but that remains a threat in the background.
Yeah. Okay. Well, let's see the developments over the weekend. Bloomberg's Stuart Livingstone-Wallace, executive editor for Middle East, North Africa, and Russia. And coming up, the Democratic Republic of Congo is planning on pivoting away from China's dominance over its mining industry. We have the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. The Democratic Republic of Congo is planning on pivoting away from China's dominance over its mining industry. The mines minister says the government is considering multiple options to have more control over cobalt and other key mineral exports. Part of the plan includes streamlining customs and taxes alongside a UAE partnership. Let's bring in our Chief Africa correspondent, Jennifer Zabazaja, who joins us from Johannesburg. Jen, first of all, what is the catalyst for them deciding to make this decision in the first place? And how do they plan on executing this strategy and so-called pivot away from China control?
Right. Giovanna, it's quite impressive that they are able to say this at this point in time, especially if you look at the position that China takes within their mines. Look, Congo has for a long time been touted as a country that can play a key role in the value chain of critical minerals, but they've long relied on China to get those minerals out to their other markets that they're exporting to. And so it seems like they're now trying to capitalize on the opportunities that they're seeing in front of them. So you mentioned part of their strategy. The mines minister, though, did tell us that they're looking for better investors, more investors, and diversified investors. And that's a quote there. And they're also being strategic about who owns their mines. They recently opposed the takeover of one of their mines by a Chinese firm. And so it's seeming like they're trying to look to other countries to potentially look for more joint ventures. You mentioned the UAE as one of them. They're also potentially looking to Saudi and to Western companies to be a part of that. They're also going to invest in their railway infrastructure to help get some of those minerals exported out. So, yes, it's seeming like they want to be a part of the value chain in various different ways. And potentially this is a good opportunity, especially if you look at where we're at in the transition and the role that they could play.
I was going to say, why do you think this is of strategic interest to those other international investors that you just cited?
I mean, we've been hearing about the transition for a while, right? But a lot of the companies that are part of the transition and are making and producing these batteries are looking for ways to be cheaper, to be more efficient, and also to get their emissions down. Those are a lot of the boxes that the DRC can check, especially if you look at sort of the wrath of, or the abundance of minerals that they have across the country. But they are dealing with a number of issues in the Eastern Congo in particular. There's been concerns about violence. We had a report this week from the GAO speaking specifically about how violence has still proliferated in the Eastern Congo. And the Congo is saying they're looking at companies that potentially could be liable for destabilizing the region. Not just that, we're taking a look at cobalt prices right now. Commodity prices are fluctuating right now. And so it's really going to depend on what we see with those prices to actually understand or get a sense for what the DRC can actually benefit from them. So potentially it is a good opportunity because of the position that they sit at globally in terms of a lot of these minerals. But they are facing a number of issues and challenges to actually getting there and dominating the market, especially because China right now is the dominant player.
Yeah. Absolutely. Bloomberg's Jennifer Zabazaja, thank you so much. And for more stories like this from the continent, be sure to subscribe to the Next Africa newsletter on the terminal and on our website, and our podcast available on Apple, Spotify, and wherever you get your podcasts. All right, let's pick up the conversation with another look at how some of these futures are trading as we head into the European session. What we got was a slightly negative close for Wall Street yesterday, a better Asian market session with the exception of China. I was just reading a note now put out by our markets team that about a third of the China rally has actually been erased in the last couple of days. So keep that in mind as we head into the weekend with this important announcement from the Finance Ministry. But as we look ahead to today, S&P futures are pointing to about 6 basis points higher, the Nasdaq about 9 basis points higher, Euro Stoxx 50 in Europe up about 1/3%. They're keeping an eye out on the French budget developments. Coming up, caution in China with shares sliding. We'll get Mark Mobius's take on the economy and Beijing's fiscal stimulus. Stay with us. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Asian equities outside China climb as traders sidestep the hotter-than-expected core inflation print out of the U.S. 3 Fed officials seemingly unfazed by the CPI report. Mainland Chinese stocks extending declines ahead of Saturday's crucial briefing by the finance minister. Investors expecting around $280 billion of new stimulus. Israel's security cabinet meets to discuss how to retaliate against Iran for last week's missile attack. Plus, automaker Stellantis replaces its finance chief as part of a broad management overhaul. We're live in Berlin. It's just gone 8:30 a.m. across the Emirates. I'm Jumana Versace in Dubai. Well, the market is digesting that harder-than-expected inflation print yesterday alongside a bigger spike than expected in jobless claims. So you got something for the hawks and something for the doves. In the end, what we got was a bit of a pullback for the S&P, closing 0.2% weaker yesterday, but again, very close to these all-time record highs. As you spoke about yesterday, 44 record highs this year for the S&P. We continue to go from strength to strength. Watching out today for the beginning of earnings season. JPMorgan and Wells Fargo kicking things off. 2-year yield sitting at 3.96. We rallied a couple of basis points yesterday in the session. Brent just shy of $80 as we wait for that Israel reprisal to Iran's ballistic missile attack. And then Asia Pacific, broadly speaking, the handover positive from some of these Asian markets, up 0.3% with the exception of China this morning. We'll get to that in a moment. Switching over, let me just highlight to you how big of a jump we had in those jobless claims numbers yesterday, because we saw a bit of a spike, and there is somewhat of an impact coming through from Hurricane Elaine, in addition to auto cuts that are showing up here as well. But if you can see it from this chart, we haven't seen such a big jump since 2021. So it's been a couple of years since these initial jobless claims figures came through this high. So something to think about as we piece through all of the information coming through from the U.S. economy. But let's also check in on how markets in Asia are faring. Avril Hong is in our Singapore studio. Avril.
Yeah, Jumana, we're seeing a mixed bag. Asia stock markets mostly managing to clock gains, brushing off that hotter than expected US CPI print, with the exception of China, where we are seeing the CSI 300 declining about 2% in the morning session. Hong Kong markets are shut. It's a long weekend there, but really the focus is on what we're going to get out of Saturday's Chinese Finance Ministry briefing, and some investors think we could see as much as $283 billion worth of stimulus announced. But it's not just about the amount. It is also important to watch the target of this proposed support, because that would give us a sense of what the government's priorities are going to be. Let's flip the board and take a look at what we're seeing in the FX space as well, because the Chinese yuan is still managing gains. But note here that this is on a day where most Asian currencies, say for the Japanese yen, are climbing against the greenback. The Korean won getting an extra boost from a hawkish cut from the Bank of Korea. That cut as expected, but indeed has joined the global wave of easing, becoming the latest emerging market central bank to do so. Jumana.
Avril, thank you so much. Well, for more on China, let's get some perspective now with Mark Mobius, chairman of the Mobius Emerging Opportunities Fund. Good to have you with us, and also at such an interesting time for global markets here. Well, unfortunately, we seem to have lost connection with Mark Mobius. We will be back with him in just a couple of moments, but it is a very important time for Chinese equities, given the stimulus measures that were unveiled last week, and the expectation that more is going to come this weekend with that widely anticipated Finance Ministry press conference is set to take place tomorrow. Some big numbers are being thrown about here. $280 billion worth of stimulus is what the market seems to be centering on right now. So expectations are building once more, and you've got to wonder whether the stage is set for some disappointment come Monday. So it is going to be a big weekend as far as Asian markets are concerned. And we will get back to Mark Mobius once we reestablish connection. But for now, a look at some of the other stories that we're following. The WTO says global goods trade will grow less than initially forecast next year due to geopolitical risks and political uncertainty. The Geneva-based organization now sees trade growing by 3%, less than the 3.3% growth seen 5 months ago. The WTO says risks to the trade outlook are now firmly on the downside. And Florida gets a first glimpse of Hurricane Milton's devastating toll. The powerful winds left millions without power, crops damaged, homes destroyed, and at least 10 people dead. President Joe Biden said Congress should return from its recess to pass emergency relief after Milton wreaked havoc on Florida's Gulf Coast. Milton delivered a quick, hard blow to the center of the state, tearing across the peninsula in just a few hours before racing back out to sea. So let's get back now to the conversation we started to have earlier. Mark Mobius joins us, chairman of the Mobius Emerging Opportunities Fund, and there you are, so I know you're with us this time. Look, it has been a very interesting couple of weeks for Chinese equities with the stimulus measures unveiled, a lot of liquidity support, property support measures too, and now there seems to be a big expectation that we're going to get more fiscal stimulus over the course of the weekend. Do you see this as China's whatever it takes moment?
Yes, I think they are going to continue to try to revive the market even more than it's been revived. And the reason for that, of course, is they want money to be coming into China. As you know, there's a lot of financing that's required, and foreign money coming in would help in this effort. So I think the Chinese want to see that market going much better than it's been going even now. Of course, there'll be corrections along the way. But you must remember the key point is that with China being something, depending on the index, 20 to 30% of any emerging market index, when China moves up dramatically the way it's done, the whole index moves up. And investors, which maybe 50% of all investors in emerging markets follow the index, they must put money into China. So we're in a situation now where China is going to be in a win-win situation. They have simulated the property market and other markets with lower interest rates and uh, lower mortgage rates in particular. And this is going to help push up the market and encourage more foreign investors to come in. And of course, domestic investors. At the end of the day, domestic investors drive the market, but foreign investors are going to be very important, particularly the big institutional investors who've been very doubtful about China up to now.
It sounds to me that you're pretty bullish on where Chinese equities can go from here, despite the short-term volatility we've seen this week.
Yes, I think they're on the way to a more bullish, longer-term market, provided they continue these policies. And most significant is the statement by Xi Jinping was that he wanted to encourage enterprise. That's a very, very significant statement because before this time, there was a feeling that he was down on private enterprise. He wanted more lead by the government. But now it seems that the policies are beginning to change. So that's very, very significant. So it's going to be a sort of accelerating development with more and more people piling in as a result of the index moving up. Of course, India is doing so well. So you have these two powerhouses moving the index.
Yeah, you mentioned India, and I just wonder if you think there's going to be somewhat of an internal rotation within these MSCI emerging market indices, because India actually, metrics, is a lot richer. It's trading at around 25 PE ratio versus, say, the CSI 300 trading at a 16 PE ratio. Do you expect there to be some internal rotation within EM away from China plus countries, India, back into China again, given the valuation?
Yeah, there will be rotation. I would say, not say rotation, but I would say addition, because you must remember up to now, many investors, in fact, most of the big institutional investors were against China. They didn't want to hear anything about China because they got burned so badly. Now that's changing. As that money comes in, the total pool of money going into emerging markets will expand. So it doesn't mean that money will be pulled out of India, but money will be pulled into the index stocks, including and particularly China. And you're going to see this whole market moving. You must remember, emerging markets now are outperforming the US market because of this dual situation with India and China moving up at such a good pace.
Though over the last year, though, the S&P is up about 30%. Some of these MSCI index, because of the China pullback, up until 2 weeks ago, was only up around 20%. Let me just ask you, looking ahead and piecing together what we have out of China, but also the indicators coming through from the US economy, how do you expect the relative performance to be in 2025? Do you continue to think that the MSCI Emerging Markets Index is going to outperform US markets?
I think the emerging markets will outperform for a number of reasons. First of all, I think the US market will not do as well as it's been doing up to now because there's a lot of turmoil. Regardless of who wins the election, there'll be lots of turmoil taking place. Oil prices, if something blows up in the Middle East and Iran is attacked, oil prices will spike, and that won't be good for the US economy, even though Trump may want to, if he wants to pump up U.S. production. That takes time. It's not going to happen overnight. So I think the U.S. market will continue to do well, but not as well as the emerging markets.
Do you have a view on where the Fed are going to end up in this rate cutting cycle? And again, drawing on some comments that we had on Bloomberg TV with Jamie Dimon, the likes of Ray Dalio, both of them saying that investors shouldn't be surprised to see rates actually ending up higher than what is baked in. Where do you stand on that debate, sir?
That's a very, very good point that Dimon and others have made, and because they're kind of skeptical about the Fed lowering rates. I believe, and again, depending on how the election goes, I believe that after the election, the Fed will continue to lower rates simply because they realize that this is going to have an impact on the economy. And that I disagree with the idea that rates will go up again.
Yeah, Very clear, even though we did see a bit of an inflationary upward surprise yesterday. Mark Mobius, thank you so much. Going to have to leave it there. Chairman of Mobius Emerging Opportunities Fund. Always great to talk to you. Well, coming up, changes at the top. Automaker Stellantis has replaced its CFO and is kicking off a search for its top executive. We have all the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jemana Versace in Dubai. In the UK, after 100 days in office, companies are still waiting for the new government's growth plans. Prime Minister Keir Starmer has been warning that the first budget later this month will be painful for those with the broadest shoulders. Potential proposals have ranged from smaller tweaks in line with other countries to bigger changes like boosting the tax rate for carried interest, fund managers' portion of profits on asset sales to 45% from the current level of 28%. And elsewhere, France has unveiled its budget for the next year, hitting big firms and the wealthy to trim a colossal debt pile. The country is aiming to deliver 60 billion euros worth of tax hikes and spending cuts to tackle a spiraling fiscal deficit. Under the plans, a temporary levy will be slapped on 440 firms to raise 12 billion euros in the next year. The budget is a crucial part of the government's efforts to restore political and fiscal order after months of uncertainty following snap elections. And speaking of that uncertainty, let's just take a look at how 10-year French spreads are trading versus Germany. They have shot up ever since those European parliamentary elections, ever since the snap elections were called in France. You can see big jump over the course of the summer, and we haven't really fully recovered. We're about 50 basis points wider than where we were before, about 40 basis points wider than where we were before all of this political backdrop change, and no signs ahead of this actually coming in again. So something to bear in mind as we think about the potential impact that these wider spreads could have also on GDP, on French GDP. So it's something to bear in mind as we think about the budget. And there you go. So if spreads over German yields stay 30 basis points wider, according to Bloomberg Economics, that will shave off 0.5% of French GDP. Now, speaking of France, Stellantis is replacing its finance chief as part of a broad management overhaul as it tries to regain investor trust and stabilize its business. CFO Natalie Knight will be replaced by Doug Osterman. So let's bring in Bloomberg's Oliver Crook, who joins us from Berlin and has been looking at this story. So just bring us the latest. How much of a surprise is it that the CFO is now stepping down?
Yeah, listen, Jemana, we had an idea that something needed to change over at Stellantis after we got that profit warning about 2 weeks ago that really sent the shares careening after those results came out after a year that has already been really very challenging for Stellantis. And so what we got over the sort of last couple of days with this board meeting is Carlos Tavares basically cleaning house, getting rid of the CFO, replacing the COO, replacing the COO in North America, replacing the heads of Maserati and Alfa Romeo. So really a very, very large change from Carlos Tavares over in the United States. And really, it's been a very challenging picture for the auto sector, broadly speaking. But there have been some idiosyncratic issues over at Stellantis. They have a lot of inventory in the United States that they're having trouble moving. They've had issues with the unions. And Jemana, if that was not enough, he's going straight from that meeting over to testify in Italian parliament to lawmakers because they're very concerned about potential job cuts and factory closures. So those are all the sort of issues that Carlos Tavares is dealing with in basically the last year now of his tenure. They're looking for his CEO, the replacement of the CEO. And really what he needs to do is both continue to cut costs, which he's already been doing for a long time, while at the same time bringing sort of new exciting cars to market. And we'll get an idea of how he intends to do that when we speak to him on Monday from the Paris Car Show.
Oh, excellent. So we're going to be keenly awaiting that interview. But look, how much are the issues setting back Stellantis specific to Stellantis, and how much of it is just a reflection of all of the auto stories that you've been reporting on this summer and the fact that the numbers from the likes of their competitors, Mercedes, BMW, have also been disappointing as well?
Listen, it's all. I mean, it's all of these things put together. You have individual issues at sort of BMW, where you had that sort of that brake recall. At Stellantis, again, you have the issues with the sort of unions. You have some quality issues. You have some massive inventories issues over the United States. But what we got overnight in the last couple of days was the sort of numbers from Mercedes and BMW, their delivery numbers for the third quarter, which really put a little bit of fragrance around kind of the profit warnings that they gave a couple weeks ago. So Mercedes, you know, they had overall sales down 3%, BMW down 13%, but Jumana, when you look at their critical markets in China, this is where the story gets really interesting and frankly very negative, where you had Mercedes sales in China down 13%. BMW, Jumana, sales in China down 30%. So that is losing 30% of your biggest market in the third quarter. That is a substantial decline. There is one silver lining, though, Jumana. We should say that in the EV space, BMW has continued to outshine the other competitors over in Europe. They managed, despite a sort of very negative quarter for deliveries, managed to raise battery electric vehicle sales by 10%. Mercedes, on the other hand, was down 30%. So a little bit of distinction when you break down those delivery numbers, but overall not a terribly positive picture for the auto sector.
Interesting. Oliver, always great to have you on with the insight, the sharp insight into what's been happening with these European automakers. Oliver Crook, thanks. Now, coming up, JPMorgan and Wells Fargo are set to report third quarter earnings before the U.S. market opens today. More on what investors are watching out for next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Financial sector earnings kick off later today with reports from Wall Street giants JPMorgan and Wells Fargo. Their net interest income outlook and capital markets revenue will be in focus following September's Fed rate cut. For more on this, Bloomberg's Charlie Wells joins us now. Charlie, I think we have to go back to some comments that the JPMorgan CFO made in anticipation of this earnings season. He was warning that analysts probably have too high an estimate of NII penciled in for 2025. How does that set the stage for what we're going to get from them today?
Jumana, I mean, Daniel Pinto of JPMorgan certainly did try to set that stage, and he tried to set that stage a little bit lower than a lot of analysts had been anticipating. So he made comments last month saying that they'd been too optimistic about net interest income. And that, of course, is banks' largest source of revenue. It is crucial for them. And over the past few years, it's been incredibly positive. Banks, the largest banks, particularly in the United States, have set records. But the concern is, in a lower rate environment, that becomes a little bit more difficult. And so executives like Pinto have tried to temper demand. And today, and this is why today is going to be so interesting, is the first set of results since the Fed lowered those rates. And we're going to see, was this Pinto, like many other executives, just trying to set that lower floor? Or are those net interest income results kind of as low as people maybe expect? And particularly, are those projections for the next year also negative?
Yeah, well, we spoke about Daniel Pinto's comments, but also around the same time as Daniel Pinto spoke about a month ago, we heard from David Solomon, the CEO of Goldman Sachs, and he also warned that trading activity was on track to be about 10% lower in the third quarter. So what does that tell you as well about the signals about what to expect on the trading side?
I mean, look, markets have been doing pretty well, and I think this may have fueled some analysts' expectations of, incredibly, positive trading activity as well. Now, as far as the banks that we're going to see report today, JPMorgan, it's looking like they're going to have some positive trading activity there, so that, should potentially deliver for them and could make up for some losses in net interest income. But again, I think there's been this sense with bank stocks being so positive that management has wanted to try to temper expectations so they don't plummet if results underwhelm today.
Yeah, and then also looming large behind all of this is the regulatory landscape. U.S. banks have had a bit of a win recently because it seems like some of those initial proposals that were going to be put forward have actually been watered down.
they had a bit of a win and they waged a bit of a campaign, I would say. So there was so much fear that regulators would require these banks to have more capital on hand, and they will not have to have quite as much as was expected. And this was a campaign where banks were literally advertising during football matches in the United States, trying to explain what higher capital requirements would mean for them. So this is positive, and it's looking like if things go well, that positive trajectory that we've seen for their share prices, the KBWI bank index is up, JPMorgan share price is up about 25%, beating the S&P 500. If they are able to keep up that positive regulatory story, if they can show strength in trading, and if they can show that they can pivot to this lower rate era, that should have a lot of strong momentum for these bank stocks.
Yeah, well, let's see. We'll find out in a few hours. Bloomberg's Charlie Wells, thank you so much, and thank you for joining us on a Friday. Well, Berkshire Hathaway has trimmed its Bank of America stake below the 10% regulatory threshold, requiring rapid disclosure. A selling spree that began in mid-July has helped Warren Buffett's firm reap about $10.5 billion from its years-long investment in the bank. Berkshire now only needs to provide quarterly updates on its holdings. And a quick look at markets before we head out. It has been a week of volatility for global markets, but as we head into the European session, Euro Stoxx futures indicated in the green, S&P futures, Nasdaq trading sideways. But that was it for our show today. Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.